In the world of real estate, savvy investors seek ways to maximize returns and minimize tax liabilities. One powerful tool is the 1031 exchange, named after Section 1031 of the Internal Revenue Code. It allows investors to defer capital gains taxes by reinvesting proceeds into a similar property. Think of it like a trade, swapping one investment property for another. By following specific rules and timelines, you can avoid paying taxes on the profit. This deferred gain can grow tax-free until you cash out, if you ever do. The primary reason investors utilize 1031 exchanges is the significant tax advantage they offer. Imagine selling a property for a substantial profit. Without a 1031 exchange, you would be liable for capital gains taxes on that profit, potentially losing a significant portion of your earnings. By engaging in a 1031 exchange, you can defer those taxes, keeping more of your money working for you. This allows you to reinvest your full profit, potentially purchasing a larger property or diversifying into multiple properties without a hefty tax bill. This can lead to significant wealth accumulation over time. In essence, a 1031 exchange frees up capital that would otherwise be paid in taxes, providing you with more resources to reinvest and grow your real estate portfolio. This can be particularly beneficial in a rising market where property values are increasing, allowing you to maximize your returns. One of the most compelling aspects of 1031 exchanges is the potential to defer capital gains taxes indefinitely. This strategy involves continually rolling over gains from one investment property to another throughout your lifetime. By strategically timing your exchanges and reinvesting in appreciating assets, you can potentially avoid paying any capital gains tax ever during your lifetime. At that point, your heirs would inherit the property with a stepped-up basis, with hardly any capital gains to pay. It's one of the best ways to give the taxman your best one-fingered salute. We're just kidding, Uncle Sam, of course. However, it's essential to consult with a qualified 1031 intermediary with a track record of completing these deals, and pay close attention to changing IRS rules. Sometimes, a 1031 exchange is not totally tax-free. This may be accidental because of poor planning, or by design depending on your tax situation. Although there are a few different ways to calculate if your exchange will be tax-free, we like the simplicity of the debt and equity method. There are basically two kinds of taxable income you may have from a 1031 exchange. The first we'll call equity boot. The second we'll call debt boot. For any tax-free 1031 exchange, you'll have to maintain or increase your equity in the replacement property. Let's look at an example of this. Here, notice that the equity available in your replacement property is higher than it was in your old property. This is because the new property has less debt, and the purchase price was even higher. Because your equity increased, you've passed the first hurdle. You'll have no taxable equity boot in your exchange. But what happens if your equity decreases instead? In this example, your equity decreased by $60,000. This is mainly because you took on a lot more debt on the new property. In this case, you will definitely have at least $60,000 of taxable equity boot from your exchange, and you won't be able to get around it. Now, what about the debt boot? When the debt on your new property is more than the debt on your old property, you'll never have any debt boot. In this example, you took out extra debt to finance the new property, so you're guaranteed not to have any debt boot on your exchange. However, in this example, you reduced your debt load, meaning that you bought your new replacement property mostly with cash instead of taking on large replacement mortgages. In this case, your debt decreased by $105,000. At first glance, you might say you're going to automatically have $105,000 in taxable debt boot because of this debt decrease. That's a rational assumption, but here there's a special exception that may give you an out. Let's look. Let's say you do a 1031 exchange and increase your equity on the new property by $200,000. So we know you don't have any equity boot on the deal, but your debt load on the new property decreased by the $105,000 we saw on the last slide. Now, you get to offset your initial debt boot with your equity increase, all the way down to zero. You'll only have taxable debt boot if your equity increase isn't enough to offset it. So this exchange is entirely tax-free, no equity boot or debt boot to report. All in all, 1031 exchanges are relatively straightforward if you're dealing with a qualified intermediary and an experienced tax pro. But be sure to research your intermediary to make sure they're reliable and experienced. While the 1031 intermediary is required to hold your funds securely pending the completion of your exchange, some intermediaries have proven to lack adequate insurance or controls to safeguard your funds. In some cases, investors have been left out in the cold, with little recourse if their intermediary suddenly fails or declares bankruptcy. Sometimes, you may actually want to recognize some of the gain from a 1031 deal, so you may intentionally structure the deal to have debt boot or equity boot. This is common when a taxpayer has big losses in the current year or prior year passive losses from the property, which can be used to offset any 1031 boot gain. While the rules and regulations surrounding 1031 exchanges can be complex, the potential benefits make them a strategy worth exploring. By working with experienced professionals and carefully planning your exchanges, you can leverage this tax-advantaged tool to achieve your real estate investment goals. Thanks for watching, and good real estate hunting.